Hi, Rod and I are here today to continue our series on individual executive benefits. We last time talked about deferred compensation plan, which is one form of executive benefits. Today we're here to talk about restricted stock. So what is a restricted stock? A restricted stock is compensation in the form of company shares. Typically, when you are granted shares from the company, they are not readily available to you. That's where the word restricted comes in. So you receive this grant that at some point in the future will become valuable to you. The shares vest either on an annual basis or sometimes over what they call a cliff vesting period, which we typically see in our practice a 3 to 4 year period.
So when you receive a grant of restricted stock, at that time there is no tax consequence. And then as the shares vest over time, that is when the value of the stock at the time that it vests becomes taxable to you.
What type of tax consequence is this? This is ordinary income, which means it will show up on your W-2. Typically, when the shares vest, your employer will withhold income taxes, both federal and state as applicable. You will see it show up in your payroll, and you will receive net after-tax shares. So what's next? So you have to make a decision. Do you continue to hold these shares, or do you sell the after-tax shares and invest in other investment options? That's something we would recommend that you discuss with your financial professional to see how it would fit in with your overall financial goals.
From an income tax standpoint, the decision to sell at that time, there's really minimal, if any, additional tax consequence if you sell the shares at that time, because your cost basis in the stock for tax purposes is the value of the stock when it vested. So if you could simultaneously sell the shares the moment they vest, there would be no additional income tax. If you decide to hold the shares for a longer time period, then hold them. You may want to consider holding the shares at least 12 months from the date that they vested, because then you get long-term capital gain tax treatment. The holding period for capital gain and loss starts on the day those shares vest. From a financial planning perspective, our typical advice is, look, your salary, your bonus, all of your other forms of executive compensation are coming to you from the company, and you typically are overweight in terms of your exposure to your company's stock. So when those shares vest, if there's really no further tax consequence for selling them, why wouldn't you sell them at that point in time? Think of it as, if you had an equivalent value of cash, given your overall financial situation, would you take that cash and buy those shares of your company's stock? And typically the answer is going to be no. So why wouldn't you do the reverse and sell those shares once you're able to? There could be one reason you may not be able to sell right away is if you're an insider of the company subject to certain trading window restrictions. So then you wait until that first open window that you have to be able to sell the shares. So that is our typical guidance on how you then integrate that value from those shares into your long-term plan and diversify it out into your portfolio.